class it was a temporary network glitch. We're talking about the replacement method. We said you have two methods. You can use method one, annual equivalent cost method. We are going to use this method if you are not giving revenue information about the assets to be replaced. You are only giving the cost of the asset. You are giving the cost related to the asset. The acquisition cost, the maintenance cost, the running cost. No information is given about revenue generated by the asset. In that case, you are going to use annual equivalent cost method. The annual equivalent cost is the present value of cost divided by the annuity factor. The annual equivalent cost is the present value of the cost divided by the annuity factor. Number two method, annual equivalent value. We are going to use annual equivalent value if the examiner gives both revenue and the cost. You are giving the cost of maintaining the asset. You are giving the revenue generated by the asset. In that case, you are going to use annual equivalent value. Your annual equivalent value is the net present value divided by the annuity factor. We explained this last week. We now solve a question last week. We solved question number one. We solved question number one. Tonight we are going to take question number two. Please refer to page 164. Page 164, question 2. I hope I'm correct. I should be correct. Oh no, it's not correct. So please go to page 82 or 83. Page 82/83. Question number 2. Can somebody reconfirm this page? We need to move on. Can somebody reconfirm this page?
Confirm.
All right. Thank you, Namdi. We move with the question. Germany Limited uses regularly a machine which costs 100 million naira when new. When the machine is new, it will cost 100 million. The machine resale value is 60 million after year 1, 34 million after year 2, 12 million after year 4, and nil. So 12 million after year 3, and nil after year 4, after 4 years. That information is missing. Nil after 4 years, which is the maximum physical life. The maximum life of the machine is 4 years. The machine annual revenue and cost, which arises on the last day of each year and vary according to the machine age, as follows. You have revenue for year 1 to year 4, running costs for year 1 to year 4. Germany Limited always buy new machine, and the company has a cost of capital of 15%. You are required to prepare calculations showing whether Germany Limited should continue to replace the machine in the future, and if so, at what age should the machine be replaced? When should we replace the machine? Unlike the question we solved last week, examiners specify after 3 years or after 4 years. Unlike the question we solved last week, examiners specify we should consider after year 3 or after year 4. This question, the examiner didn't specify. The examiner asks us, the machine is for 4 years. When should we replace the machine? That is, if you buy the machine in year 0, you are going to buy the machine in year 0. And the machine has a maximum life of 4 years. When should we replace this machine? You have 4 options. Should we replace after year 1? That is, we are going to buy the machine in year 1. Sorry, we are going to buy the machine in year 0. After 1 year, we are going to sell the machine and replace with a new one. That is option 1. Or we can buy the machine in year 0. We use it for year 1, year 2. After year 2, we can scrap the machine. Or we can buy the machine in year 0. We use it for 3 years. After 3 years, we can sell the machine. Or you can buy the machine in year 0. After 4 years, you can sell the machine and buy a new one. That means you have 4 options, because the maximum life of the machine is 4 years. In this case, we are going to consider the 4 options. Look at it, please. Please, let's try to be part of the class. Please, let's try to be part of the class. You might log on and you are still not part of the class. Open the question, get your calculator, and even also solve in the class. It's a way of reading. Option 1. Replace after 1 year. In this case, you are going to have the year. The machine will be purchased in year 0. We are going to use it for 1 year. After 1 year, we are going to sell it. What are the relevant cash flow? Initial cost of the machine. Let us assume 30 up for convenience. Now, initial cost. The machine will cost 100 million naira. We are going to buy in year 0. We are going to use it. We are going to generate revenue in year 1. Look at the revenue in the question for year 1. 64,000. Also in year 1, we are going to incur running costs. Running costs for year 1, 8,000. Then at the end of year 1, page 82, stroke 83. Question number 2. Question 2. At the end of year 1, machine resale value. What is the resale value of the machine? Examiner say you can sell the machine for 60,000. Look at it here, please. Revenue for year 1. Running cost for year 1. The machine resale value, 60 million after 1 year. Now get your net cash flow. For year 0, you have 100,000. 64 plus 60 minus 8, 116,000. You have gotten the net cash flow. Introduce your discount factor at 15%. Year zero. Discount factor is 1. Year 1, 0.875. Now get the present value. 1 multiplied by 100. Thank you. 116 multiplied by 0.87. 100,920. Now calculate your MPV. 920. If the machine is purchased in year 0 and replaced in year 1, the MPV is positive. Now get the annual equivalent value. Annual equivalence value. The formula is MPV divided by the annuity factor. Annuity factor for 1 year, because the machine will be replaced after 1 year. Annuity factor for 1 year. Annual equivalent value is equal to your MPV 920. Annuity factor for 1 year at 15% is the same as 0.870. Now please get the annual equivalent value. 920 divided by 0.8. 1,057. So if the machine is purchased in year 0 and replaced after year 1, the annual equivalent value is 1,057. Option 2. How do you get 192? Or are you just joining the class?
Good evening, sir.
Multiply 100 multiplied by the discount factor here, 100. 116,000 by the discount factor. Multiply by 0.870. 109.20. How that is settled. Option 2. Option 2. Replace after 2 years. You are going to use it for year 1. You are going to use it for year 2. After year 2, you are going to sell the machine. What is the annual equivalent value of this option 2? You have your year 0, we are going to buy the machine. Year 1, year 2. Initial cost of the machine, okay? You have 30 up. Initial cost of the machine will cost 100 million. We are going to buy in year 0. Revenue. We are going to use the machine in year 1. We are going to generate revenue of 64 million. We are going to use the machine in year 2. We are going to generate revenue of 60 million. Running costs. We are going to incur running costs of 8 million in year 1. 10 million in year 2. Resale value. We are not reselling in year 1. So we don't have business with year 1 resale value. We are going to sell the machine in year 2. What is the machine value, resale value in year 2? 34 million. Place under year 2. Since you are not selling the machine in year 1, you cannot generate resale value for year 1. If you sell in year 2, you are going to generate 34 million. Get your net cash flow. Year 0, 100 million. Year 1, 56 million. Year 2, 84 million. Introduce your discount factor at 15%. For year 0 is 1. Year 1, 0.870. Year 2, 0.756. Please get your present value. Multiply. 1 multiplied by 100. 100. 56 multiplied by 0.870. What do you have? 48 48 what? I'm not even sure. $48,720. Next, 84,000. Thank you. Multiply by 0.76.
63,504.
63,504. Now get your MPV. Sum your positive, minus it from the negative. MPV is equal to 12,224. Now, calculate annual equivalent value. MPV over annuity factor for 2 years. The machine will be replaced after 2 years. Please compute annuity factor for 2 years at 15%. The annual equivalent value is equal to the MPV 12,224 divided by 1.626. Here, the annual equivalent value is 7,518 approximately.
Approximately, yes.
We move to option 3. Option 3. Replace after 3 years. That is, you are going to buy the asset in year 0. We are going to use it for year 1, year 2, and year 3. After year 3, we are going to sell the asset. 30 up. Initial cost of the assets. We can buy the machine for 100 million. Revenue from the assets. In year 1, we are going to generate 64,000. Year 2, 60,000. Year 3, 50,000. $56,000, sorry. Year 3, the revenue is 56. We are going to incur running costs. For year 1, 8,000. Year 2, 10,000. Year 3, 14,000. At the end of year 3, the resale value of the machine, 12 million. You cannot pick resale value for year 1 because you are not selling the machine after year 1. You can't pick resale value for year 2 because you are not selling the machine after year 2. You are going to sell after year 3. Now get your net cash flow. The net cash flow. Negative 56, 50,
54,
the last one, 56, plus 12, minus 14, 54,000. Introduce your discount factor at 15%.
2.283.
What is 2.23?
So are we getting discount factor on annuity?
Are you following the question?
Sir?
Discount factor first. Are you following the question, Moses?
Although I just joined, but I noticed you've been using annuity factor since. That's why I calculated annuity factor.
Can you see the screen?
Yes, I can still see the screen, sir.
So what is the discount? We are trying to get the MPV first. What is the discount factor for year 0? 1.
1, yes.
Discount factor for year 1, 0.870. For year 2, 0.756. For year 3,
0.658.
Now get your present value. Multiply the net cash flow by the discount factor. 1 multiplied by 100. 100 negative. 0.87 multiplied by 56,000.
48,720.
48,720. 0.756 multiplied by 500. By 50,000, sorry.
37,800.
37,800.
The last one, 35,532.
So it's always good to follow the class. 35,532. Now get your MPV first. Add your positive. Then remove the negative. What is the MPV? 22,000 watts.
052.
052. Now you have gotten the MPV. You now want to calculate annual equivalent value. The formula for annual equivalent value, MPV divided by the annuity factor. The annuity factor for 3 years. Because option 3, we are going to replace the machine after 3 years. Is that clear, please?
Yes, sir.
Now, you can now give me the annuity factor for 3 years.
2.283.
Good. 22,052 divided by 2.283. What is the annual equivalent value?
9,659.
9,600 is what?
59.
Oh, 59. Thank you. You have gotten the annual equivalent value if the machine is replaced after 3 years. Then the last option. Option 4. Replace after 4 years. In this case, you are going to purchase the machine in year 0. The year 0, we are going to use it for year 1, year 2, year 3, and year 4. Naira sign. You are going to purchase the machine in year 0. What is the initial cost of the machine? 100 million. Revenue. You are going to use the machine for year 1. You generate 64,000. Year 2, you generate 60,000. Year 3, you generate 56,000 running costs. You are going to incur 8,000 in year 0, year 1. 10,000 in year 2. 14,000 in year 3. 20,000 in year 4. Your resale value after year 4, nil. Now get your net cash flow. Net cash flow. 100,000 year 0. 56,000 year 1. 50,000 is here. This should be 42,000. This should be 30,000. Introduce your discount factor at 15%. Discount factor at 15%. Year 0 is 1, 0.870, 0.756, 0.658, and 0.572.
7172.
0.572. Please get your present value. $48. What do you have here? 37,800. Next.
I think it's 35,532.
That's changed. The figure has changed.
Okay, that's changed.
$27,636.
The last one.
And the last one, 17,160.
Yeah, that's correct. 17,160. I'm trying to squeeze it, Leo. There's no space. So please help me sum up and give me MPV. Add all the positive, then remove the negative. MPV 31,000 watts. Oh yeah,
31,316.
316.
Yes.
Now go and get annual equivalent value. The MPV net present value divided by the annuity factor. Annuity factor for 4 years.
2.854.
For 4 years. 855.
Yes.
The annual equivalent value 31,316 divided by 2.855. What do you have, please? 10,000?
$10,969.
969. Okay, 969. Approximately.
69. You have tested the 4 options. Now, look at all the value. Look at all the annual equivalent value. Which one do you have the highest annual equivalent value? If you compare option 1, option 2, option 3, option 4, which of the option will give you the highest annual equivalent value?
4.
Option 4. You are going to recommend option 4. Recommendation. The machine should be purchased and replaced after 4 years of use. This is because option 4 provides highest annual equivalence value. We are done with the question. So please note, to round up, if you are dealing with annual equivalent cost, you are going to pick that option that minimizes your cost. Assuming you are using annual equivalent cost, like the question we solved last week, we pick that option that gives us the lowest cost. But if you are dealing with annual equivalent value, you are going to pick that option that gives you the highest annual equivalent value as your replacement option. Is that clear, please?
Yes, sir.
All right, please remember all the questions we have solved. Examiner will give you the cost of capital. At this level, examiner cannot give you question without cost of capital. All right, please. The assignment is still there. There's a question I said you should check. Look at this question number 4. It's on your study pack. I also shared with the group chats. Review this question to test your understanding. Review this question to test your understanding of asset replacement strategy. On this note, we move to the next topic. On this note, we shall move to the next topic. Our next topic is capital rationing. I'm going to share the material now with this, with the group chats. That is the next topic after asset replacement. Sorry, I'm trying to look at the question or the material that we can get started. What is capital rationing? While I try to share the material, we can explain small. When you say capital rationing, a situation where a company does not have sufficient capital, a situation of shortage of capital to finance viable investments. When you say capital rationing is a situation where a company has a viable project, a project with positive net present value. But the company cannot undertake the project because the company does not have capital. No finance to fund the viable project. I will share the material now. So capital rationing, we can define it as a situation where a company cannot undertake a positive net present value project because of shortage of funds or because of budget constraints. Budget constraints imposed by capital expenditure budgets. I'm going to explain that. I'm going to explain that. All right, you can go. All right, let me share this material now. All right, let's go to it. That should be the next topic after asset replacement. I think page 90 or so. After asset replacement, check your study part. Capital rationing. All right, we move to this topic. Capital rationing. Capital rationing is a situation where a company cannot undertake all positive net present value projects because of shortage of funds or budget ceiling placed on capital expenditure. So please note, there are two reasons why you can have capital rationing. One is there is shortage of funds. Our company has a viable project. What is viable project? A project with positive net present value. Because we don't have money, because we don't have funds, we cannot finance such projects. So one reason for capital rationing is shortage of funds. The second reason is budget constraints. What we call budget constraints placed on capital expenditure. Let us explain that. Assuming the management of the company says our capital expenditure budget is 500 million for this financial year. Management said we are budgeting 500 million for capital expenditure. That means once you get to 500 million, even if you have a viable project, you have a positive net present value project, management has given a directive that the maximum amount we are going to use for capital projects is 500 million. That creates a budget limit. We cannot finance any project. Even if the project has a positive NPV. All right. Nature of capital rationing. There are two types, or there are two natures. We have hard capital rationing. Hard. Hard capital rationing. This occurs where there is real shortage of funds for investment. The company does not have capital to finance projects. Again, the company cannot raise capital from external sources. Hard capital rationing has to do with market imperfection. Please note, hard capital rationing, you cannot borrow money. Nobody is willing to borrow you money. You cannot issue shares. Nobody is willing to buy your shares. Even if you issue shares, investors are not willing to buy your shares. This has to do with market imperfections. Because in a perfect market, capital is freely available. When you have a perfect market situation, capital is expected to be freely available as long as there is positive net present value projects. You are going to get capital. But when you have a positive net present value project and you can't obtain capital to finance the project, this has to do with market imperfections. That is hard capital rationing. Hard capital rationing is as a result of share price could be as a result of your share price has been depressed. If you issue more shares, stock market will not burn. Lenders are not willing to borrow you money. Government may place control on lending, making it difficult for companies to borrow. That is hard capital rationing. Then you have soft capital rationing. This, of course, where there is sufficient fund to invest in positive net present value projects. But because of constraints by the budget, because of budget limitation, as approved by management, you cannot execute viable projects. At times you go to your management, you discuss business proposal with your management, you discuss business prospects. You have identified a business. You are very sure that this business will generate profits. You now approach management. Management said, no, we don't want to do any project now. We have money, but we have placed a budget. We don't want to go beyond this budget. That is soft capital rationing. This may be as a result of management decision. Management is unwilling to issue more shares. Acting on behalf of the shareholders, we don't want to issue additional shares and raise more money. We want to avoid dilution. At times, management may limit investment to the level they can finance from retained earnings. That we only want to use our retained earnings to finance projects. We don't want to borrow money. The management is not willing to borrow money. We don't want to be committed to a fixed interest payment. This is soft capital rationing. All right. We can now have types of capital rationing situation. Majorly, there are two. You can have single period capital rationing with divisible projects. Please listen to this. Single period capital rationing with divisible projects. Let us explain that. When you say single period capital rationing, a situation where finance will be short, a situation where shortage of funds will only happen in 1 year, in a single period. Single period capital rationing is a situation where capital shortage is expected to happen in a single period. After that period, capital is available freely. That is single period capital rationing. Then we have divisible projects. What is divisible projects? These are projects that can be divided into percentage. These are projects that you can accept. You can accept partly. You can take a fraction. For example, if a project will cost 100 million, if I'm to do the project 100%, I require 100 million. But I only have 50 million. If that project is divisible, then I can do 50% of the project. That is divisible project. Project that you can do part of. If you can do 50%, that means you can achieve 50% of the project NPV. If you can do 50%, that means you can achieve 50% of the project NPV. That is divisible project. Please note, all projects are assumed to be divisible unless the examiner states otherwise. Please note, all projects are assumed to be divisible unless the examiner states otherwise. When you are faced with single period capital rationing and the project is divisible, let me take that again. When you are faced with single period capital rationing and the project is divisible, project selection will be based on profitability index. I will take that point again. When you are faced with a single period capital rationing and examiner says the project is divisible, project selection will be based on the profitability index. The higher the profitability index, the better the project. Your profitability index is calculated as NPV divided by the capital investment in the year of rationing. Your profitability index is calculated as the NPV divided by the capital investment in the year of rationing. Or you can calculate as your profitability index, present value of cash inflow divided by the present value of initial capital investment. Either method will give you the same results. Either method will give you the same results. So we have discussed single period with divisible projects. You can also have single period. Single period with indivisible projects. You can also have single period with indivisible projects. Indivisible projects are projects that cannot be divided into fractions. You either accept the project 100% or reject it. You cannot do 10%, 20%, 50%. It is either you do the project 100% or you don't do the project at all. It is either you accept the project 100% or you don't do the project at all. If you are faced with indivisible projects, project selection will consider the net present value, and you are going to look at all possible combination of projects. Please listen very well. You are going to look at all possible combination of projects that utilizes or that uses as much as possible the capital available. You are going to look at different combinations that use the capital available as much as possible. Then you are going to select that combination that gives you the highest net present value. You are going to look at the different combinations that use available capital as much as possible. Then you are going to select that combination that produces the highest total net present value. Finally, multi-period capital rationing. When we say multi-period, a situation where capital shortage will occur more than one single period. It's a situation where capital rationing will occur more than one single period. The capital rationing will occur multi-period. It could be 2 years, 3 years, capital shortage. When you are faced with multi-period capital rationing with divisible projects, when you are faced with multi-period capital rationing with divisible projects, project selection will be based on linear programming. You are going to use linear programming to determine the project selection. However, this is outside your syllabus. Examiner says, for the purpose of this exam, the question will only be tested on single period capital rationing. So all the question we are going to solve will be limited to single period capital rationing. All the question we are going to solve will be limited to your syllabus. So there won't be any point going into linear programming as far as this topic is concerned. Any question, please? You can look at question 1. Please, can we refer to page? Okay, let me even check the page here. Let's see if you can solve 1 or 2 questions. Let me check the page here. Capital rationing, page 85 here. Page 85. Okay. Others can be explained in class. Look at question number 6, page 90. Let's look at question 6 and 7, page 90 and page 91. Check page 90. Page 90, question 6. Then page 92, page 91, question 7. If time permits, we can treat this question. Now look at question 1. A company has 20 million naira to invest. There are 4 projects available for investment, all similar in terms of risk. The amount of investment required and the NPV of each project are as follows. Project A, capital required 8 million, NPV positive 3 million. Project B, capital required 5 million, NPV positive 2 million. Project C, capital required 6 million, NPV negative 2.5 million. Project C is not viable. You are going to reject project C. Project D, capital required 10 million, NPV 4.2 million. Requirements. Which project should be selected if they are divisible? And which should be selected if they are not divisible? We can go to this quickly. Let's go to this, copy it. So for your exam, examiner will not give you multi-products, multi-periods. First, reject project C. Project C is not financially viable. We now have 3 projects remaining. We are supposed to accept all the projects. We are supposed to accept all the projects. Now let's check. Assuming you want to accept all the projects, what is the total capital required? Please sum up. 8 million plus 5 million, 13 plus 10. We require 23 million. This is solution to A. Please, hold on, let me check. I want to be sure. No, let's place this one here. Let's place it here, please. This should be placed here to avoid confusion. This should be placed here. Aha.
Why not? To be here now, don't be here. Please sit here. Now look at it. If I'm to accept the 3 projects, I require 23 million. Examiner said the company only has 20 million for investment. That means the capital available is not sufficient to finance all viable projects. And we have been told that we if the project is visible, profitability index. In this case, you are going to calculate profitability index. Please, let's go on with the class. Let us expand this more. The margin is a bit small. So here is our profitability in the PI. This is PI. This is your ranking. What is the formula for profitability index? Profitability index equal to NPV divided by capital required. Oh yeah. NPV for project A, 3 divided by 8. Yeah, 0.375. Please don't round up. Or be careful with rounding up. Go to project B. 2 divided by 5. 0.4. Project D. 4.2 divided by 10. 0.42. Now rank based on the highest. Project D first, followed by project B second, followed by project A, what you are saying is that you are going to do project D first. Out of the 20 million, you are going to do project B, project D. Now, when you are done ranking, go to your project selection. Oh, okay, require space. Let me check if there is free that we can use. Let's copy this. Let's copy this one. Add it to this side. Where? Return to your calculation. Now next, our project selection. Project selection. Capital. Because of space. Let me reduce this place. Projects. Capital. Then cumulative capital. Then your NPV. You start with project D. Project B capital require 10 million. Cumulative capital 10 million. NPV of project B, project D, 4.2 million. Then project B second. Capital require 5 million. Cumulative capital 15 million. 5 plus 10. NPV of project B, 2 million. Now project A. Remember, the total capital available is 20 million. And you have spent 15 million. Project A. Capital required is 8 million. And we have spent 15 million out of 20 million. That means we only have 5 million remaining. That means you can get 100%. You now check. What is the percentage of project A we can do? We only have 5 million remaining for project A. Project A is 8 million. Please work out the percentage. You can only do 5 million out of 8 million. That means you can only do 62.5%. If you apply 5 million to project A, cumulative 20 million, you can only do, if you work out this, you can only do 62.5%. of project A. Examiner say the projects are divisible. You can only do 62.5% of project A. Hence, you can only achieve 62.5% of project A MPV. Look at the MPV of project A. If I do 8 million, I will get 3 million MPV. If you now do 5 million, what is the MPV? You can only get 62.5% of that MPV. So calculate the MPV you can get. 62.5% of 3 million. You can only achieve 1.875 out of the 3 million. In this case, sum up the MPV plus 6.2. 8.075 million. Your recommendation here. If the project is divisible, recommendation, accept projects D, comma, B, and 62.5% of project A. This will give a total MPV of 8,000,075. You have treated if the project is divisible. You have treated if the project is divisible.
Requirement B.
Requirement B. Which project should be selected if the projects are not divisible? Definitely we can select project C. Project C is not viable. You cannot consider project C. Again, you are going to look at the MPV and different combinations. Again, pick the projects. Copy this. I'll place this here. Remove project C. Project C is not profitable. So delete We are now left with 3 projects. We now look at the project NPV, where the project is not divisible. There are 2 things to consider. The project NPV and different combinations. If you rank this based on NPV, project D, followed by project A, now followed by project B. But you are still going to take combination. What do you call possible combination? Possible combination. Capital NPV. If I do project A and B, if I take that 2 projects, total capital is 13 million. NPV 3 plus 2, 5 million. If I do A and D, A and D, 8 plus 10, total capital is 18 million. NPV 3 plus 4.2, 7.2 million. If I do B and D, B and D, 5 plus 10, I'm going to use 15 million. NPV 6.2. We have 3 possible combinations, A and B, or B and A and D, or D and A, B and D. Now look at the combination. Which one will give you the highest NPV, total NPV? Combination A and D. Because the projects are not divisible. If I combine A and D, we are going to spend 18 million out of 20 million. We are going to get net present value 7.2 million. That is where you have highest NPV, total NPV. Your recommendation: if the projects are not divisible, accept projects A and D. Total capital required $18 million. Total NPV Total net present value. $7.2 million. Out of 20 million, you are going to invest 18 million in projects A and D. What is the balance? 2 million. A cash balance of 2 million naira is remaining. You are done. In this case, you cannot do half. So you are going to look at project combination that will give you the maximum NPV. Any question, please? Before we move to question 7. Any question before we move to question number 7? If there's no question, please move to page 91, question number 7. No, I don't need you. Let me copy this quickly. I'm going to require it. You can go through the question before we start. All right. I'll take this here. Place here. I don't need this here. Delete. All right, let's go to the question. Chief Dan Limited is considering an investment in the following projects. The cost and NPV of the project are given. We have project Alpha Bravo Charlie, Delta Echo and Foxtrot. We are giving the cost of the project and we are giving the NPV of the project. All the projects have positive NPV. That means we are supposed to accept all these projects. Once a project has a positive NPV, that project is financially viable and should be accepted. Once a project has positive NPV, That project is financially profitable and the project is supposed to be undertaken. The company only has 13 million naira available for investment at a cost of capital of 15%. Surplus funds are reinvested at 20%. You are required to advise Chidan on project combination to select under the following conditions. All the projects are independent. All right, let's start with that. If all the projects are independent, we are supposed to accept all the projects. We can do all the projects independently. But do we have sufficient funds to fund all the projects? Let's go on with the class. Now, please check. Add all the costs. Let us look at the total investment cost. 1,800 plus 2,000 plus 2,500. Please add the cost. Yes, what do you have, please?
13,800.
Cost required.
13,800.
Philip, I can hear you now.
It's 13,800.
All right, look at it. The total capital required for all the projects is 13,800. That is 13,800,000. How much is the capital available? Please check here.
13 million.
That means we don't have sufficient capital to undertake all the projects. That means we don't have sufficient to take all the viable projects. In this case, there is capital rationing. In this case, there is capital shortage. and we assume that the project is divisible. In this case, we are going to calculate profitability index. We are dealing with A. All the projects are independent. In this case, you are going to calculate your profitability index. MPV divided by the capital required. Please divide 1,080 divided by 1,800.
0.6.
0.6. Thank you. .6. Next, 900 divided by 2,000.
0.45.
0.45. Next, 16225.
0.65.
0.65. Next, 1,450 divided by 3,000. 0.43. Next, 1,344 divided by 28. 0.48. Then finally, 1,003 divided by 1,7.
0.59.
0.59. Zero 0.59. Now do your ranking from the highest. First, second, third, fourth, fifth, and sixth. What you are saying is that you are going to take project chart first. Now go to project selection. Projects, capital required, cumulative capital, the MPV. Project Charlie. What is the cost of Project Charlie? 2,500. Remember, we have 13,000. Assuming 301. Cumulative 25. What is the MPV of Project Charlie? 1625. Followed by Project Alpha. Capital cost required 1,800. Cumulative 4,300. MPV of Project Alpha 1080. First drop. That is rank number 3. Capital cost 1,700. Cumulative 6,000. MPV 1003. Followed by project data. Capital required 3,000. Cumulative capital 9,000. The MPV of project data 1450. Followed by project number 5 rank. Echo. Capital cost 2,800. Cumulative 11,800. MPV 13,444. We now have project Bravo. Now don't forget, you only have 13 million and you have spent 11,800. Project Bravo is 2,000, 2 million naira. Out of 13 million, you have spent 11,800. You are left with what? 1,200. That means you cannot do Bravo 100%. You require 2 million for Bravo. You only have 1.2 million. What is the percentage? 1.2 divided by 2,000.
60.
Thank you. That means we can only accept 60% of Bravo. Cumulative 13,000. If you undertake 60% of Bravo, you can only get 60% of the MPV. MPV of Bravo is 900. If I calculate 60% for Bravo MPV, 60% of 900.
540.
You can only gain 540. Sum up. That's your recommendation. If the project are independent, that's your recommendation. Select product, do 100% of product, Charlie, Alpha, Foxtrot, Delta, and Echo. Then do 60% of Bravo, total MPV.
7042.
7042. If all projects are independent, the company should undertake projects as shown in the calculation above, you are covered. What you are saying is that you are going to follow the calculation above. You are covered. Do project Charlie 100%, project Alpha 100%, project Foxtrot 100%, project Delta 100%, project Echo 100%, and do project Bravo 60%. That will give you a total MPV of 7,042,000. We only have like 8 minutes. Requirement B. Project Echo and Foxtrot are mutually exclusive. What is the meaning of mutually exclusive? Mutually exclusive means that the two projects cannot be accepted together. Once you accept project Echo, you cannot accept project Foxtrot. Once you accept project Foxtrot, you cannot accept project Echo. The two projects are mutually exclusive. You cannot do the two projects together. In this case, we are going to create two groups. We are going to consider two groups. Group 1, if Echo is considered. If Echo is considered. Group 1, if we consider Echo. In this case, you cannot consider Foxtrot. Go back to your ranking. You are still going to start with the ions. You are going to pick Charles. Oh. Let's put Eddie. The project capital, cumulative capital MPV. You pick project Charlie. This project will cost 2,500, 2.5 million. Cumulative 2.5. MPV 1625. Followed by Alpha. Project cost 1.8. Cumulative 4.3. MPV 1080. Rank 3. first truck. We can't consider first truck because we want to consider equity. You now pick next round, delta. We cannot consider first trucks. Delta 3000. Okay. We consider delta. This will cost 3000. Total 73. MPV 1450. We now consider echo. Echo will cost 2,800. $2,008. Cumulative 73 plus 28. 10,100. We now go to Bravo. Amount 2,000. MPVA 1344. Cumulative here 12,100. MPV 900. We cannot consider first truck. Out of 13,000, we have spent 12,100. Surplus cash. Surplus cash. Let me show it. 13,000 minus 12,100. We have 900. Examiner say your surplus fund can be reinvested. Examiner says surplus fund can be reinvested at 20%. What is the NPV of the reinvestment? Surplus fund equal this. Now look at it. NPV of reinvestment, surplus fund. Let me place this here. Surplus fund 900. Now calculate the NPV of reinvestment. You have year 0. Your item, cash flow, discount factor, and present value. You have surplus fund. Surplus fund amounts 900. You can reinvest it. Then year 1 to infinity. Return. Please compute 20% of 900. You are going to get 180. Return on investment from year 1 to infinity. We now need to calculate NPV of this. You are going to reinvest 900 in year 0. You are going to get a return of 20% from year 1 to perpetuity. The cost of capital of this company is 15%. Let's get the NPV. For year 0, this is 1. You now want to calculate discount factor from year 1 to infinity. Please note, the discount factor for year 1 to infinity is 1 over the discount rate. Your discount rate is 0.15. The discount factor for year 1 to infinity is simply 1 divided by the discount rate. Now get your present value. 1 multiplied by 900, negative 900. 1 over 0.15 multiplied by 180. Just multiply it. 1 divided by 0.1 multiplied by 180. You are going to get 1,200. Yeah, 1,200. Your NPV. If you reinvest the surplus fund, NPV is equal to 300. You can return here now. We are going to stop the class now. Just come here. We have done the working down. That working is done there. Surplus fund. Surplus fund. 900. Cumulative. To complete 13,000. NPV of surplus fund. 300. This is group 1. Now, sum of the NPV. If echo is considered, sum of the NPV.
6699.
6699.
99.
This is group 1. You now go to group 2. So you are going to demonstrate this group 2. I don't want to take the class too much. Come to group 2. If phosphorus is considered, in this case, you can't consider echo. You still come here. You are still going to pick, you are still going to copy this up to this point. If you allow me to copy it, no, let me do it from here. Just for, no, undo. If I do like this now, up to this point, if I can copy, to save time, I'll just come here. Allow me to place it here. Let me see if you allow me. Aha. You are still going to pick Charlie, Alpha, Delta. Can I create a space here? Is it possible? Aha. Now I will now place I'll pick phosphorus. Project cost. $1,700. Cumulative 6,000. MPV 1003. Delta cumulative 9,000. Yes, please go ahead, Phillips.
So I did not consider the Bravo.
Why? What is Bravo? Is Bravo, we are looking at ranking now. You pick Charles. Is that not how we do? Bravo will now come later. What is rank of Bravo? Bravo is rank 6. Why do you want to pick Bravo first? I pick Charles, followed by Alpha, followed by Phosphorus, followed by Delta. I can't pick Echo because it's mutually exclusive. I will now go to Bravo. So Philip, you now bring Bravo here. This is first, second, third, fourth, fifth. Bravo is 2,000. Cumulative 11,000. This is 900. You now have surplus fund. Surplus fund. Out of 13,000, you have spent 11. Surplus fund is 2,000. Examiner says surplus fund can be reinvested at 20%. Now go and calculate NPV of surplus fund without wasting time. Your yield, item, cash flow, discount factor at 15%, then present value. Year 0, your surplus fund reinvested 2,000. Discount factor 1. NPV 2,000 negative. Year 1 to infinity. Return on surplus fund. Examiner say 20% return. Control 20% of 2,000. You are going to get 400. From year 1 to perpetuity. The discount factor, year 1 to perpetuity, 1 over the discount rate. Then the present value, 1 divided by 0.15 multiplied by 400. You have 2667 approximately. NPV 667. Now pick the NPV return yield. NPV of surplus fund 667. Please sum up. What is the NPV of the second alternative? This plus this plus this. Please sum up. We need to round up.
It's 6725.
6725. Now compare the two groups. If echo and first drop is mutually exclusive, which of the two groups will give you the higher NPV? The group with first drop, group 2. Look at group 1. NPV 6699. Second one 6725. You are going to recommend group 2 if echo and first drop are mutually exclusive. Then the company should accept the group 2 that contain first drop. We shall stop here. In fact, this 15 minutes says, we shall stop here. We round up the topic next week. All right. Sorry, we have to take extra 15 minutes. I wish I can finish the question. Any question, clarification, I will be stepping out.